When it comes to investing, a key to doing your own due diligence is to understand some of the fundamentals. Today, we are going to look at 6 surface level fundamentals that can help you sift the winning stocks from, well, the losers. Fasten your seatbelts, folks. This is going to be a good one. Fundamental analysis is an approach to evaluating stocks that involves examining a company's financial statements, management, industry position, and overall economic conditions to determine, well, we're looking for its intrinsic value. By analyzing factors such as revenue, earnings, cash flow, and debt levels, investors can assess a company's financial health, growth potential, and overall stability. This information will help you identify undervalued or overvalued stocks, and it gives you that opportunity to make informed decisions when choosing which stocks you want to buy, hold, or even sell. In essence, fundamental analysis provides you that solid foundation for understanding any company that you're looking at, their true value, and their potential, as well as serving as a critical tool for making some sound investment decisions, especially when you're looking for long-term investments. We will be looking at some of those fundamentals in this video. I have selected 6 that include earnings per share, price to earnings ratio, price to book ratio, return on equity, free cash flow, and payout ratio. Of course, these all fall within our surface level fundamentals. There are more advanced statistics that we could definitely look at in a future video. So join that conversation. Let us know in the comments if you want to see even more of these fundamental explainers. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that. Click. This fundamental explainer video was by multiple requests, so I hope you guys enjoy it. So without any further ado, let's just get right into this. Our first fundamental is earnings per share, or EPS. Now, EPS measures the portion of a company's profit allocated to each outstanding share of, well, their common stock. It's calculated very easily by dividing the company's net income by the total number of outstanding shares. EPS is an important metric because, well, it helps investors compare the profitability of different companies. A higher EPS indicates that a company is more profitable, while, of course, the inverse, a lower EPS, suggests lower profitability. If you run into that situation where that EPS is in the negative zone, well, it doesn't mean the Fantastic Four are coming. It means that the company is losing money, and that can be a warning sign against investment. Next, we have the price to earnings ratio, or PE ratio for short. The PE ratio is a valuation ratio, and it's simply calculated by dividing the market price per share by the earnings per share. Pretty simple. This PE ratio, it does help investors determine if a stock is overvalued or undervalued. A lower PE ratio may indicate that a stock is undervalued, while if it's higher, it might suggest that it's overvalued. However, when you are looking at a PE ratio, it's always best to compare them to other PE ratios from stocks within that same industry or even within that same peer group. Different sectors may have different average PE ratios, so comparing across sectors is absolutely usually not very useful. It is for that reason that when I include the PE ratio when I'm doing my deep dives, I do add the average as well for the sector, just so that you guys have something to compare it to. A negative PE ratio, now that indicates that the company has negative earnings, which can be a sign of financial distress. But hold on a second, that's not always true. It can also be an indication that the company is in a growth phase with a lot of heavy reinvestment. It is usually important to do extra research to figure out which of these cases is true, especially if the company you're looking at tends to be a growth-focused company. The third fundamental is the price-to-book ratio, or PB ratio. The PB ratio, it compares a company's market value to its book value, which is the value of a company's asset minus its liabilities. The PB ratio is calculated by dividing the market price per share by the book value per share. A lower price-to-book ratio may indicate that a stock is undervalued, while, of course, a higher PB ratio can suggest overvaluation. Like the PE ratio, it's very useful to compare PB ratios with other companies in the same industry. Like the PE ratio, we can get a negative PB ratio, and when we see that, it means the company's liabilities exceed its assets, which could signal some financial instability. Maybe it's a warning sign, but once again, this is a situation which is a call to do more research. A negative PB ratio could also be the result of a company pouring capital and debt into a growth scenario that overall may be a good thing for long-term growth. Our fourth fundamental, which is one of my favorites, is return on equity, or ROE. Return on equity measures a company's profitability by calculating how much profit it generates with the money shareholders have invested. It's calculated by dividing the company's net income by its shareholders' equity. In this case, a higher ROE indicates that a company is using its shareholders' investments more efficiently to generate profits. ROE can be used to compare the performance of different companies in the same industry or even across different industries. A negative ROE implies that the company is operating at a loss, which should be a red flag for investors. The fifth fundamental is free cash flow, or FCF. FCF represents the cash generated by a company's operations that is available for distribution to its investors after accounting for capital expenditures. It is simply calculated by subtracting capital expenditures from the operating cash flow. Free cash flow is an important metric because it does provide us a little bit of insight into a company's ability to generate cash. Cash is good. That cash, of course, can be used for various purposes, such as paying dividends, reducing debt, love that one, or investing in growth opportunity. A positive FCH indicates that a company is generating more cash than it's spending, while a negative free cash flow means that company is spending more than it's generating. Negative free cash flows can occur for growing companies that are heavily investing in their future. However, sustained negative free cash flow may be a warning sign of a not so great investment opportunity. Finally, we have the payout ratio. So the payout ratio measures the percentage of earnings a company pays to its shareholders as dividends. Simple as that. It's your share of their profit pie. It is easily calculated by dividing the total dividends that are paid out by the company by its net income. A lower payout ratio indicates that a company is retaining more of its earnings for growth, while a higher payout ratio shows that a larger portion of earnings is being distributed, usually as dividends. A payout ratio over 100% means that a company is paying out more in dividends than it is generating in net income. This situation can, of course, occur for a lot of different reasons. One could be a temporary dip in earnings, or it could even be a deliberate decision by the company to maintain or increase dividends despite lower earnings. While the high payout ratio and, as a result, usually some pretty big dividends, they may be very attractive to income-seeking investors, at least in the short term. Keep in mind, it can be unsustainable in the long term, and if the company is unable to generate sufficient earnings to cover its dividend payments, we could have some issues. While a high payout ratio might be attractive to income-seeking investors in the short term, it can be unsustainable in the long term, especially if the company is unable to generate sufficient earnings to cover all of those dividend payments. It's nice to get the really high yields, but you got to be paying attention on to whether or not that company can afford to keep doing it. A consistently high payout ratio, that may indicate that the company is not retaining enough earnings for future growth, and they may be struggling with some financial stability. That, of course, can lead to future dividend cuts, or there can be some other negative consequences for shareholders. Each of these metrics we looked at today provides valuable insights into a company's financial health, valuation, and performance. By understanding and using fundamentals, you can make more informed investment decisions. This is always a good thing, and it's a great way to help you evaluate potential opportunities. When we evaluate these statistics, always keep in mind that sometimes a lower than ideal result, it's not because that company is in trouble, but a lot of times it can be because of growth. And that's why we always want to be doing a bit more due diligence. We want to dive in. Now, if you have warning signs firing across all of these statistics on the surface level, that's a good indication that that's a company you may not want to even bother going any deeper into. One big exception is if you are looking into a very big growth company, you probably do want to go further, even if the surface data looks a little bit wonky. That just might be because they've pumped a whole lot of cash into some future growth that's going to turn around and, well, it's going to create a lot of growth opportunity a little bit further down the line. Once again, if you want to see more of these fundamental explainer videos, hit me up in the comments and let me know. Keep the learning going. Watch my video on Canadian Natural Resources Limited, linked over there on the left, or you can test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video. Holy banana bread, why are you still here? The video is over. I don't have extra credit scenes. I'm not Marvel.